Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Moving away a bit from President Trump and his policies, Japanese yen has been quietly appreciating. The yen, which was trading around 157 in January, is currently trading around 150 against the US dollar. Morning JK, we have been seeing a trend of stronger yen and higher bond yields in Japan. How do you read into that? And can we have another episode like we did after the first hike by the BOJ?
Hi, good morning, Swaraj. Yes, yen strength has been definitely noticeable. If you remember, after this hike, the latest hike by the Bank of Japan to 0.5% in their policy rate, the yen actually moved higher, rather, the USD yen moved higher towards 156. But since then, we have dropped to 150 and we traded as low as 149.50 also today. Today's inflation number coming at 4%. Also, was a big shocker for the bond market in Japan, where the yields have hit 2008 high. So all these things are supporting Japanese, and of course there is another statement from Bank of Japan official that they will be further normalizing their interest rate. So yen is definitely a center of focus in the currency market, leading the dollar lower. But moving away from the specific currency, I think even if you look at the US economy, this it seems to be losing some momentum, and we are seeing a stream of weak data. Last week, we saw the retail sales drop heavily by 0.9%, and that's actually not a good news if it becomes a trend, because then we have the consumption, which forms a major part of US GDP, putting downward pressure on the growth. Yesterday's leading economic indicators fell by 0.3% after rising by 0.1% in December. Consumers' assessment of future business conditions turned quite pessimistic in January, with along with fewer working hours in the manufacturing regions also. Almost all the indicators in the Midwest region, that is fully fed survey, also showed a big drop, and we saw the employment, new orders, and capex, all of them actually dropping quite heavily. And the worst news yesterday was the Walmart's indication about lower profit forecasts, much less than analysts' expectation, and based on a possible drop in consumer demand. This actually was another indication that possibly the largest conglomerate is also seeing US consumption slowing, and this can have a actually see the a pressure, downward pressure on the GDP number also. So apart from the stock market coming off, particularly the Dow, which lost more than 1%, we saw the yields also come off, and the dollar lose ground against most of the currencies yesterday. In fact, yesterday we saw a clear indication of a bias for the dollar to weaken, because despite all the geopolitical challenges that Europe is now facing in terms of no funding from US for their defense, and also the political challenge in Germany, where the elections are going to be held in Sunday, and the throwing up a lot of uncertainty. Despite that, euro has bounced almost 1% from its lows, and with yen strength also quite dominating. Yesterday, when we saw the Trump administration proposing to impose tariffs on more products, market actually took them in the stride, and it looks as though market has reached a tariff fatigue, where it is not really reacting as they did after the election in November and December. And in fact, this year also, earlier, we were seeing markets reacting quite a bit to this tariff news. More or less, the markets are convinced that the tariffs eventually will not be as severe as they are made out to be, and depending on how the negotiations go with the various countries. The good news was that Mexico said they have had very constructive talks with the US officials on trade. Uh, President Trump has indicated that a trade deal with China is quite possible, and Premier Xi is also expected to visit the US in this regard. And there was a mellowed down, talk from Zelensky, Ukraine Prime Minister, about working towards a lasting solution for the Russia-Ukraine war. So these are good news, which actually removed the edge of the dollar, and dollar actually lost ground once again, falling below 170, and in fact a close below 106.50, which is the technical level on the weekly chart, today being Friday. If it closes there, I think there more losses can be expected for the dollar index. And of course, we will watch out for how the German elections pan out tomorrow. But the bias for the dollar remains for weakness, and then eventually a test of 105 or 105.50 can be seen in dollars, which means that the broader grains for euro and yen can be foreseen in the coming days. We have, of course, had the rupee also reacting positively to the global developments of a ceasefire possible in Ukraine war, and then of course the dollar index recovery, China trade deal possibility, which pushed the dollar yuan lower. All these things helped the USD INR, rather the INR, to recover strongly yesterday. Um, Also, we have seen recently the level at 86.90 plus has been offering a strong resistance, and we know that markets have been holding a lot of long positions ever since we started the move from 84.50 and 85, and some of which definitely got stopped out when we moved down from 87.95. But as the market failed to even touch 87 in the recent sessions, I think yesterday we saw a lot of unwinding from foreign banks, which could be possible long unwindings. We're also seeing higher interest from exporters to hedge at the higher levels. Global cues were supporting for the rupee to strengthen. So we saw a test of 86.50, which we mentioned in our yesterday's report as the lower end of the range for the short term, and the higher, of course, higher level, of course, 87.20 was not even tested. So we are possibly in this range, but if we do see a further slippage in the dollar index, USD INR can actually technically test a level near 86.10 and 86.15, and that could be a base for some time, because that's where we expect PSU banks to resume some buying of the dollar and mop up if there are if there is more selling from the market. But I think for me, USD INR remains capped now, and I will reassess fresh weakness in the INR only if we break above 87.20. Thank you.
Thank you, JK. And I think the broad theme is correction in the dollar. Dollar indexes in the correction mode, and further correction can be expected. All of this comes down to uh, the recent data from the US, which seems not to be very encouraging, both in terms of consumer sentiment and manufacturing. One of the biggest retailers in the US, Walmart, is also seeing some stress due to the softer consumer demand. When it comes to other currencies, we have got the Japanese inflation, which was at 4% year on year in January. Strong bets are now being placed on the rate hike by BOJ. So overall, softer dollar and softer US yields, and despite all the political challenges and tariff for Europe, euro trades higher. So broadly, all currencies are recovering against the dollar. Rupee also reacted positively due to the softer dollar index and recovery in Asian currencies, because Chinese yuan has also corrected from 7.30 to around 7.2524. And in recent sessions, USD-INR has failed to cross rupees 87 mark, leading to long position unwinding and fresh exporter selling. We'll keep this trend in check. That's it from us today. Thanks for listening. Tune in next week for the fresh round of updates on the markets. Thanks for listening.